Welcome to Toronto Path TV Underground. My name is Don Givelis, and today we have a special guest from a contributor to Toronto Path TV. His name is Mark Slater. He's with CIBC Wood Gundy, and today we're going to talk about RRSPs. Mark, welcome to the show.
Thanks, Don. Thanks for having me.
You're welcome. Before we talk a little bit about RRSPs and the do's, don'ts, and the good, the bad, and the ugly about them, I wanted if you could talk to our guests and our viewers a little bit about yourself. Tell us about how you got into this business and what you do at CIBC Wood Gundy.
Sure. I've been with CIBC Wood Gundy for the last 16 years. I am a vice president and portfolio manager and a personal financial planner. That's what I do. We work with a number of clients and advise them on tax, estate planning, and investment solutions for themselves and their families. Okay,
and we're now just nearing the RRSP deadline, and that's coming up soon. So why don't we start with that? When is the RRSP deadline for Canadians?
So this year, the deadline is Wednesday, February the 29th. So that is the last day that you can do a contribution and use that tax deduction against your 2011 taxable income.
So we get an extra day this year because it's a leap year?
You do, yes.
Okay. After that time, can we not contribute and put it towards this year, or can we contribute after that, but it will go to the future year? Is that how it works?
Correct. So up until February 29th, you can use the contribution for the previous year or the following year, so 2012. But after that, you can only use it for 2012.
So typically a lot of people leave it to the last minute, and one of the questions I have, and I'm just as guilty as everyone else, is how much can I contribute? How do we know and how can we find out what amounts we can contribute? What's the quickest way to find that out?
So the quickest way to find it out is through your notice of assessment that you got for your 2010 tax return. You just look on there and it'll tell you what that amount is. If you can't seem to find that, and as we're counting down, there's only a few days left, a very quick calculation is you take 18% of your earned income for 2010, and if you've had pension adjustments, then you remove that, but basically you come up with an amount. So simply, if you earned $100,000, 18% of $100,000 would be $18,000 is your contribution room, and there's a cap of $22,450. So that's the maximum. But whatever it's the minimum of whatever the minimum is, $22,450 or 18% of your earned income minus any pension adjustments.
Okay. So I can take a look. If I can't find that information, I can guesstimate. Now I've got a figure. I wish it was as high as 18,000, but I've got my amount that I want to contribute. How do I contribute? What's the easiest way to go in and do that?
I mean, the simplest way to make a contribution, I guess, is if your company does provide you with bonuses. It's an easy way. A lot of them do allow you to contribute that bonus directly into your RRSP, and then you don't have to wait for your refund. So that's,
and they will put it directly into your
RRSP?
An
RRSP, yes. Sometimes companies have plans at work, so they'll do it directly in there, or they'll cut a check and send it to your RRSP provider, whether it be CIBC or whoever it is. So that's, I guess, the quick and easy way to do it. Certainly, if you don't have that option and you haven't got money set aside, most of the financial institutions will provide you with an RRSP loan that you have to repay over the course of 12 or 18 months. And if you're smart, you take the refund and pay off that loan or pay down that loan. And I think the smartest thing that we advise clients to do is set up a monthly or bi-weekly or whatever you're paid contribution, and this is more of a future idea, and set it up on a weekly, bi-weekly, or monthly basis and do the contribution so that you're not scrambling at the end of the year to make the contributions.
So this year that we're scrambling, we've got some information, but for next year it would be prudent for us to talk to our employer or our financial institution about putting aside once a week or once a month a regular contribution so we don't have to worry about what to do at the end of the year.
Correct.
For the contribution. What about spousal contributions? Can you talk to us a little bit about that? What are they? Are they valuable? Is it something we can do if we're married? Or?
Yeah, that's a great question. It's been asked a lot because the rules have changed. So they changed the pension rules and pension income splitting rules to allow retirement income like RIF income to be split among spouses. And that got rid of a lot of the benefits of a spousal RSP, which is what people would set up. So if you had one spouse that earned less or didn't work at all, and you wanted to be able to contribute money in their name, you can do a contribution. You as the contributor got the tax deduction, but the money would accumulate in your spouse's plan. With the changes, the pension changes, there's not as much of a benefit, but I would say that the two areas that you may want to still contribute to a spousal plan is if you plan on retiring before 65, then a spousal plan still makes sense. I'm not going to get into the details, but it does still make sense. And I guess if you've got a significant age difference between you and your spouse, and the older spouse may work past age 71 when you're forced to collapse or roll your RSP into a RIF, having a spousal RSP may allow that older spouse to continue to contribute to RSPs after age 71.
So it depends on your situation and the way things are going these days. Not all of us will be retiring at 65.
That's right.
Given current world financial and economic conditions. So I've contributed my RSP, I've submitted my taxes, and because of my contribution, I've got this nice chunk of change in terms of a refund. What's the best thing you think we should do with that? Should I take a vacation? Should I buy that plasma TV? Or pay down debts? What do you suggest?
I think typically, I find most people do take that refund and spend it. If you're prudent and you have incorporated it into your financial plan, I think contributing for the following year's RSP again alleviates having to come up with the big amount of money. So, as part of a financial plan, I think one great option is to use that refund you get and start your 2012 RSP contribution room. If you do have outstanding debts like loans or mortgages, I would say pay down those mortgages or pay down those loans. When we run some numbers for clients, if you take that on a consistent basis year after year, take the refund and put it down on your mortgage, you can significantly reduce the number of years left on the mortgage just by simply following that discipline on a yearly basis.
Even with the low interest rates?
Even with low interest rates. I mean, it certainly doesn't have the same advantage, but you can significantly reduce the amortization on that mortgage by making those extra contributions to capital. Over time it adds up. Over time it adds up.
And one thing we should ask too, I think, is because I was a late bloomer and a contributor to RRSPs because I didn't have a guy like you telling me about the benefits of them. But when can you start contributing? I mean, do you start as soon as you graduate university and start your first full-time job, or do you start in your 30s, your 40s? What do you suggest?
It really depends on your financial situation. I think the biggest benefit to RSPs, so you accumulate RSP room as soon as you have earned income. So as soon as you start working and are earning an income, you accumulate RSP room. Whether to take advantage of that, right now that room accumulates and will always be there unless they change the rules. So contributing when you don't have, you're not earning a lot of money, you don't get as big a benefit. So our advice typically is if you're not earning a lot of money, let that money accumulate and you take advantage of the RSP limits later on in life when your income is higher. And with the advent of the tax-free savings accounts, which anyone over 18 can now use, I would normally suggest using the TFSA as a contribution for people that aren't in high tax brackets.
So what about someone further down the road? And I've been working for a couple of years, and a couple of years ago the government brought in the TFSA. So what do? I've got some money now, I've got a week to go before my RRSP deadline. Do I do an RRSP or do a TFSA, or if I've got enough money, do I do both?
I think, I mean, if you've got limited resources and you've got to make a choice, I think the quick rule of thumb, although I think you really need to sit down with your advisor to look at your current situation, is with an RSP, if you anticipate that your tax rate or your tax bracket is going to be higher than when you contributed to the RSP, then it probably doesn't make a lot of sense to do the RSP contribution. If your tax rate is going to be lower, you anticipate it'll be lower when you retire or start taking money out of your RSP.
Most people's are.
Then the RSP has the bigger advantage. The TFSA is the opposite. If you anticipate that your tax rate is going to be higher because the money coming out of the TFSA isn't taxed, it's
so
better
you can take money out of the TFSA and not be taxed on it?
Correct, and that is going to be another session, but we'll get into the details on TFSAs.
Right.
Yes.
Okay. Good.
Yes.
So, Mark, I want to thank you very much for the information on RRSPs. So, thanks again for coming by, and please stay tuned next time for another episode of Money Matters, hopefully with Mark Slater.
Thank you.